Hi, and welcome to my channel. For those of you new, these videos will be a mixture of tracking my journey and development towards financial freedom, about basic personal financial products, and also about improving people's financial well-being. My name's Dave and I work in financial services, and it amazes me the number of people I speak to on a day-to-day through my employment who do not understand the basics of personal finance because we don't teach the subject in schools, or in the UK we think the subject matter is taboo to talk about. Remember, if you like the videos in this channel, press the like button, subscribe to this channel so it can grow and reach a wider audience. Now let's get on to this week's video. So this month's video is about a review of my ISA holding account during the month of April. For those of you new, my plan for this year is to aim for a growth of 10% for the year and to reach a year-end value of £50,000 and to receive annual dividends of £500. So for the month of April we started at a value of £38,335. We finished the month in a very good position on £47,088, making a monthly profit of £8,753. For the year to date, we are up 12.93%. So we are well ahead of our expectations. The market is in somewhat of a rally. Hopefully that continue, but it will hopefully give us a bit of a leeway later in the year when markets will hopefully settle down. We have made contributions for this month of £7,500. Started a new tax year, we have reinvested some money from elsewhere into our ISA account to keep our accounts simplified, to save on the number of accounts we hold, but also to keep our account and our future growth and dividends within a tax-free wrapper. During the month of April, we received dividends of £24.23, from AJ Bell £12.51, and from Barclays £11.72, bringing our total dividends to date for the year of £35.27. And our monthly provider has charged us fees of £7.91. With regard to our shareholdings, that all individual shares hold picked for long-term growth, all the shares I consider are to be held below net asset value. In the portfolio we hold 9 shares, 6 in profit, 3 in loss. The shares make about 31% of our portfolio. 27% of that is in the FTSE 100, 4% is in the FTSE 250. And as we can see from the portfolio, mainly financials making up about 34% of the total holding allocation, 15% in cyclicals, and about 15% across the technology sector. Now let's run through a summary of the shareholding we hold within our account. Give you an idea of valuations, profit and loss, and the reasons for holding those respective shares. So our largest shareholding is Lloyds Bank. We own 10,000 shares. We're £4,530, 10% of our portfolio. Unfortunately showing a loss of 20%. It is now at a 12-month high. It did have very good results in the month of April. Bad debts had been written off. Write-downs had been reduced. So hopefully when the market does recover and the UK is back on some kind of track, will be one of the shareholdings to benefit moving forwards, and hopefully dividends will increase. Our next shareholding is Barclays. We own 1,172 shares, just over £2,000, 4% of our portfolio, showing a nice profit of 37%, again for the exact same reasons held with Lloyds. Our next shareholding is Sainsbury's. We own 598 shares, £1,421, 3% of our portfolio, showing a small loss of 6%. Everybody needs food, everyone needs to shop. Hopefully will produce nice cash flow in the future, nice dividend growth. Our next shareholding is Legal & General. We own 485 shares, £1,300, a nice profit of 32%. Safe, secure company. Everybody needs insurance, has some very good pensions and investment business, So hopefully a long-term hold, and it does pay a good dividend. Our next shareholding is a similar nature, Aviva. We own 415 shares, £1,661, 11% profit, and we have just purchased £500 during April. Again, because I think it's a good long-term hold. It has been on a restructuring buy, so it is concentrated on less growth companies, but it does pay a good dividend. Our next shareholding is AJ Bell, the platform provider. We own 237 shares, just over £1,000, slight profit of 6%. A growth company in my perspective. Everybody's going towards platforms and investing. They've had some very good numbers for growth, through assets under management and the long-term hold, and it does pay a very small dividend. Our next shareholding is HSBC. We own 231 shares, just over £1,000, 10% profit, and we did increase our holdings. We did buy another £500 during the month of April. Again, banking sector's in recovery, but it is more worldwide based from the UK, and it does pay a quarterly dividend. The next shareholding is Card Factory, the retailer. We own 1,126 shares, just under £1,000, slight loss of 2%. And again, we did buy £500 during the month. Hopefully the shops will be back in fashion. It is a very cash-rich company. It was paying a dividend and a special dividend, and hopefully when the UK economy comes back into fashion, people do shop again, it will be a great recovery play. And our smallest shareholding is NatWest. We did own this on another platform, but we decided to close that platform, simplify our accounts, make it easy to manage, and again it is now in a tax-free wrapper. We bought 252 shares, £500 during the month, but again a long-term hold, and it does pay a small dividend which will be due in May. And hopefully moving forwards will be a recovery play. The government will reduce their stakeholding, and we'll hopefully see a bit of growth moving forwards. Now let's go through the funds we hold within our portfolio. As we said before, we own 9 shares, 31%, and we own 14 funds, making up the remainder 69%. Some good news, all 14 funds are in profit. Now, I do not hold any ETFs or tracker funds. All the funds I hold are what we call active manage. So hopefully will give us long-term growth. Within them funds, predominantly UK based, but 56% is in the UK, 23% is invested in the US, and 21% is invested across Asia. Now, to diversify our portfolio, we did actually put £5,500 out of our investment of £7,500 into funds, which I will go through in a minute. So we put £1,000 into a US smaller company. We put £1,000 into a UK smaller company, hopefully will give us greater growth. We put £1,000 into an emerging market fund, £1,000 into a fund in China, £1,000 into a fund of global equity to hopefully give us a wider spectrum of investments, and £500 into a mid-cap small fund, again for hopefully greater levels of return. And a quick summary of our largest holdings. I say we do hold 14 share funds. I'm not going to go for them all, but just our largest funds. So our largest fund is China, £4,000, 8% of our portfolio, giving us a nice profit of 14%. Came out of COVID very quickly, a long-term growth play, and will be a major player in the world markets moving forward. Our next fund is Global Equity, just under £4,000, 8% of our portfolio, showing a very nice profit of 31%. Hopefully again we'll be moving forward a very good share, but it's been bought solely for diversification. Our next fund is quite restricted. It's Bally Gifford Positive Change, £3,900, 8%, has a very small number of shareholdings, but a nice profit of 31%. Whatever Ballygifford have done the last 12 months seems to have done great returns, so hopefully another fund for a long-term hold. They've done their homework, they seem to go for good quality investments. Our next fund, seems to be the flavour of one of the months, is a Legal and General Technology Index. £3,800, nearly 8% of our portfolio, showing a very nice profit of 51%. Predominantly weighted to US stocks, but hopefully moving forwards will be a good long-term shareholding, solely because of the number of companies it invests in. Our next investment is the US smaller companies. £3,200, 7% of our portfolio, making a nice profit of 28%. Again, but solely for long-term growth across a number of good quality US smaller companies. And our next share or fund is the UK smaller companies, £2,700, 6% of our portfolio, showing a nice profit of 10%. Hopefully when the recovery starts taking effect in the UK, we'll see some nice growth, some from nice UK smaller companies, but again being bought to diversify our holdings. Now, all the holdings we do hold is we own an AIM fund, and our smallest fund is in Russia, down to £550, 1%. So the idea of across the 14 funds is to give us some diversification. And as we say, the largest funds we're holding is about 8% of our portfolio. In future, we will presumably buy the same funds we hold, but as we proved during this month, the plan is to increase the holdings we've got within them funds. Mainly for ease of manage, because we've got 14 funds, 9 shares, they all need research, they all need looking after, but they've all been bought solely for long-term growth. I will review them once a month, and unless the circumstances change, I intend to hold all them funds for the next 3 to 5 years. But as we've said, not one ETF or tracker fund. I prepare to do the homework and the research, and hopefully by doing that we will get some growth shares which will beat the market and will increase our portfolio substantially over the coming years. Remember, if you like the videos, smash the like button and we'll see you again soon.